A 12 out of 10 presidential meeting just concluded, a meeting hailed as an overwhelming success. So why did the crypto market react by immediately and violently nosediving? We find ourselves navigating a market of profound and unsettling contradictions. In one moment, assets like XRP are charting a steady, confident climb, registering gains of over 1.3% on the day, painting a picture of stability. And then, in the blink of an eye, it happens. A sudden, violent dip erases the gains, plunging the charts deep into the red. This isn't a gentle correction, it's a brutal, automated sell-off. Yet, just as quickly as it began, it's met by an equally aggressive, opposing force. Buyers flood the market and the price snaps back, painting a perfect, sharp V shape on the chart. This wasn't a simple wave of volatility, it was a demonstration of extreme financial whiplash. The timing of this entire event is, perhaps, the most curious and revealing part. The initial sell-off, the spark that lit the fuse, ignited at a very specific hour, around 12 a.m. Eastern Time. Think about what this means. This precise timing ensures that the vast majority of the American market is fast asleep, completely unaware of the algorithmic storm brewing in the digital ledgers. By the time they wake up, check their portfolios, and sip their morning coffee, the worst of the damage and the subsequent baffling recovery has already concluded. This was an event that transpired in the shadows. This volatility, of course, was not isolated to one asset. This was a systemic shock, a tremor that rattled the entire foundation. Bitcoin itself, the bedrock of the market, felt the jolt, dropping hard before recovering its footing with similar startling speed. Ethereum, the king of smart contracts, plummeted, touching down to a low of 3,800 before being aggressively snatched back up by opportunistic buyers. Solana was not spared either, dropping sharply to 190 before its own rebound began. What this entire episode reinforces is a familiar if unsettling pattern. When these sudden, liquidation-driven events hit, Bitcoin and Ethereum demonstrate a stunning, almost reflexive resilience. They rebound almost instantly. XRP, too, managed to claw its way back, effectively erasing the drop and returning to the very levels it held before the chaos began. To truly understand the force behind this manufactured move, to look under the hood of the machine, one only needs to examine the liquidation data. This wasn't a widespread retail-driven panic. This wasn't the little guy selling off in fear. This was a culling. This was a professional, targeted execution. The vast, overwhelming majority of the financial carnage stemmed directly from Bitcoin long positions. A staggering $117 million in leveraged longs evaporated, wiped from the books. Ethereum followed, as it so often does, with nearly 25 million in its own long positions being liquidated and wiped out. Now, here is where the story gets even more specific. XRP's liquidations were, by comparison, minimal, only $3.5 million. This discrepancy tells a clear and unambiguous story. The primary targets were the high-leverage positions, the overextended bets, stacked precariously on the two market leaders. The big dogs were the target. When you tally the devastation, over $821 million in positions were liquidated across the entire market in a brief 24-hour span. The sheer blinding speed of it all is what is truly breathtaking. The market didn't just drift down, it fell 3.8% in a single hour. A drop of that severity, in that short a time frame, followed by a recovery just as fast, is not the signature of a healthy, organic price discovery market. It is the signature of something else entirely. It's the mark of algorithmic warfare. It underscores the brutal, unforgiving volatility we must all navigate, a digital arena where fortunes can be made and erased in a matter of minutes. In the short term, prediction is a fool's game. Nobody truly knows what will happen in the next hour, let alone the next day. The market can and does change in an instant, but the long-term perspective, that's where the noise begins to fade and the real signal gets clearer. The entire crypto ecosystem appears to be standing on the threshold of a new era, a fundamental transformation. A significant voice in the industry recently articulated this shift perfectly. The first 13 or 14 years of this technology were what we might call Phase 1. This initial phase was defined almost entirely by the concept of store of value. Investors entered the market primarily on the speculation of future price. It was a digital gold rush, a bet on what something could be worth, driven by narratives of scarcity and potential. But that chapter appears to be closing. We are now, definitively, entering Phase 2. This new phase is not about speculation, but application. It's about usage. We are finally seeing the real-world tangible implication of these blockchain networks. We are witnessing the rise of stablecoins, not just as a trading pair, but as a legitimate tool for settlement. We are seeing the utilization of distributed ledgers for complex processes far beyond just holding a digital asset. This profound transition from raw potential to proven utility is what makes the long-term outlook so incredibly compelling. But to get to that promising long-term future, we must first survive the chaotic short-term, and the short-term, as we just witnessed, is a minefield. It can pivot on a single headline, a single automated command. This extreme volatility is mirrored perfectly in the market's own emotional state, its collective psychology. The Crypto Fear and Greed Index is a fascinating psychological barometer. It's currently sitting deep in the territory of fear, registering around 30. What's baffling, and what truly exposes the market's fragile psyche, is that just yesterday it had leaped to 51. It briefly touched a state of neutrality, bordering on greed. That brief spike to the 50s was revealing. The market had a small rally, and instantly the collective sentiment was that everything was fine, that the danger had passed and the good times were back. But it took only one down day, one sharp correction like the one we just saw, to plunge the needle right back into the low 30s, back into a state of fear. This demonstrates just how fragile confidence is right now. The market is skittish. It is poised, ready to jump at shadows. It's a very peculiar, high-strung situation. This all contributes to the strange, lingering feeling that this October simply failed to live up to its Uptober reputation. For many, this all feels hauntingly familiar, a powerful sense of déjà vu from last year. Back then, social media was saturated with breathless predictions of a massive October rally. It was the consensus, the expected outcome, and it never materialized. History seems to be rhyming, reminding us once again that the crowd is very, very often wrong. So, what about the catalyst? What about the event that supposedly triggered all of this? The high-stakes meeting between the two presidents. By all public accounts, the meeting was declared an incredible, resounding success, hailed as a 12 out of 10. The reported outcomes that trickled out seem, on the surface, to be universally positive, the kind of news that should build confidence. We're told the U.S. is preparing for significant cuts to tariffs on goods. We have reports of an immediate resumption of massive soybean purchases. A critical one-year rare earth export deal is set to be extended. One president pledged to curb a specific illicit export, a major point of contention, while the other side agreed to cooperate on the delicate situation in Ukraine. Even the sensitive, high-stakes topic of microchips was discussed, though specifics like the new Blackwell chip were reportedly kept off the table. There were even plans laid for future state visits, a clear sign of de-escalation and improving relations. On paper, this is a checklist of diplomatic victories. This is precisely the kind of news that should stabilize markets, not send them into a terrifying nosedive. There is, however, a tangible sense of caution in the air. We are in a period where one must be exceptionally careful about what is said and what is believed. We simply do not have the full, unvarnished picture. Observers have noted that even within the crypto ecosystem, key figures seem to be stepping away. They are taking vacations, going quiet, and reducing their public exposure. This all contributes to an atmosphere of deep uncertainty. So, we must ask the question again. If the meeting was so positive, why did the market sell off? The answer, it seems, lies not in what was announced, but in what was not. The key phrase buried in the reports was that a trade deal is coming. It is not here. Nothing has been signed. The ink is not dry. This subtle semantic distinction is, in fact, everything. It means that things can still change. It means that promises are not yet policy. It means that tariffs, despite the positive talk, are all still technically in place. This lack of a definitive, finalized, and signed agreement was the gap in the armor. It failed to provide the concrete, ironclad certainty that the market desperately craved. And in that tiny vacuum of certainty, the algorithms took over. This wasn't a fund manager reading the news and deciding to sell. This was a pre-programmed algorithm detecting a sell the news event. This wasn't a retail panic. This was a coordinated algorithmic sell-off designed specifically to trigger cascading liquidations, a chain reaction that feeds on itself. It's a pattern we have seen before, a classic brutal shakeout. It serves as a stark reminder that anyone attempting to make short-term intraday moves is not trading against other humans. They are playing in an exceptionally dangerous field against high-speed machines. And so, here we are. The market is now in a fascinating, quiet state of limbo. The two largest, most anticipated events on the calendar, the recent Fed meeting and this major presidential summit, have both passed. The entire market was holding its breath for these two milestones, and now they are in the rearview mirror. The question floating in the void is, now what? The market digested the news, sold off violently, and then bounced back with equal, improbable force. Is this resilience a positive sign? One could argue compellingly that it is. The fact that buyers were willing to step in immediately, absorbing that massive sell wall and pushing prices right back up, suggests a powerful underlying demand. It suggests that despite the algorithmic games, there are strong hands waiting in the wings, ready to defend these levels. The immediate future is now an open question. We've weathered the storm of the big announcements, and the market has shown its hand, both its deep vulnerability to automated cascades and its surprising underlying strength. We are left watching to see which of these two powerful forces wins out: the short-term, high-frequency manipulation or the long-term fundamental shift toward a new phase of genuine application. The V-shaped recovery was a single, frantic battle. The war for the market's true direction is just beginning.